2025 is a turning point for investors. Artificial intelligence has gone from buzzword to backbone, housing demand is outpacing supply, and emerging markets like India are rewriting the growth story. At the same time, giants like Microsoft, Apple, and Alphabet continue to generate record cash flows while newcomers like Sea Limited and AppLovin post explosive growth. In this countdown, we rank the 20 must-buy stocks right now, from 20 to 1, based on their business fundamentals, financial health, industry dominance, and long-term growth prospects. Each pick is backed by current data and positioned to thrive in the defining megatrends of this decade. Number 20, Tesla. Tesla's second quarter of 2025 showed a significant decrease in its financial performance, with lower revenue, reduced profit margins, and less free cash flow. Despite the company's efforts in developing advanced artificial intelligence and robotics technologies, its ability to consistently deliver on its plans remains unpredictable. The increasing competition in the electric vehicle market, combined with its financial ups and downs, makes Tesla the most uncertain investment among the companies listed in this analysis. While Tesla has historically been a leader in electric vehicle innovation, its current valuation appears to be disconnected from its recent financial results, as noted by several financial analysts. The company's business model relies on selling, servicing, and charging its electric vehicles, and it has successfully positioned itself as an innovative brand. However, its competitive advantages, such as its battery supply chain and software integration, are facing increasing pressure from traditional automakers and new electric vehicle companies. Number 19, UnitedHealth Group. UnitedHealth Group reported revenues of $111.6 billion in the second quarter, which is a 13% increase. However, its adjusted earnings per share dropped to $4.08 due to higher medical costs and operational challenges. Despite these issues, a significant investment of $1.57 billion from Berkshire Hathaway shows confidence in the company. Trading at approximately 15.8 times its future earnings, UnitedHealth is seen as a company with high potential for growth, especially as it undergoes restructuring. The company has strong financial health, with a high return on assets, outperforming many of its peers in the healthcare industry. UnitedHealth Group is a major player in the healthcare sector, offering a wide range of services including health insurance and health financial services. Its long-term growth prospects are tied to the increasing demand for healthcare services and its ability to manage costs and adapt to changes in the healthcare landscape. The company is actively planning for future product offerings and refining its benefits to meet market needs. Number 18, Sea Limited. Sea Limited showed strong performance in the second quarter, with revenue increasing by 38% to $5.3 billion, gross profit rising by 52%, and net income significantly increasing to $414 million. Its earnings before interest, taxes, depreciation, and amortization reached $829 million. The company is profitable across its main business areas: gaming, online shopping, and financial technology, which positions it for continued growth in Southeast Asia's expanding digital economy. Sea Limited's financial health is considered strong, with a good profitability score. Its core operations include Shopee for e-commerce, Garena for gaming, and Sea Money for digital financial services. The company is focusing on deepening its monetization strategies, especially within Shopee, which is a dominant force in Southeast Asian online retail. Its digital financial services segment has also shown significant growth in revenue and active borrowers, indicating a strong expansion in its loan book. Number 17, Amphenol. Amphenol reported a significant increase in its second quarter 2025 revenue, which grew by 57% to $5.65 billion. Its adjusted earnings per share increased by 84%, and its free cash flow exceeded $1.1 billion. The company maintains a strong operating profit margin of approximately 25.6% and a high return on equity of about 31%. Amphenol is well positioned due to its diverse involvement in artificial intelligence infrastructure, defense, and data communication, making it a strong company that consistently grows its value. The company's financial health is robust, with excellent profitability, although there are some minor concerns regarding its overall financial stability. Amphenol's products, such as connectors and sensors, are essential components in various high-growth industries, contributing to its consistent performance. The company's ability to integrate advanced technologies into its offerings gives it a competitive edge in a rapidly evolving market. Number 16, AppLovin. AppLovin demonstrated impressive growth in the second quarter, with its earnings per share increasing by 153% and revenue by 77%. This growth was largely driven by its advanced advertising technology, which is enhanced by artificial intelligence. The company is gaining increasing support from large financial institutions, reflecting its strong performance in a specialized but highly valuable market segment. AppLovin's financial health is considered strong, though its valuation is seen as premium, suggesting little room for error. The company's core strength lies in its proprietary Axon machine learning engine, which effectively optimizes how mobile applications make money and acquire new users. This technology provides AppLovin with a significant competitive advantage in the mobile app ecosystem. Despite competitive pressures, the company has consistently beaten revenue and earnings expectations, indicating robust execution and continued market strength. Number 15, GSK. In the second quarter, GSK reported sales of £8 billion and a net profit of £1.44 billion. Its core operating profit increased by 12% when accounting for currency fluctuations. The company announced a dividend of 16 pence per share, with a target of 64 pence for the entire year, offering a dividend yield of approximately 4.5%. This strong dividend, supported by its earnings, makes GSK a stable investment for both income and growth. GSK has a strong profitability rating, though its growth has been modest. The company focuses on 6 key areas: access to medicine, global health and security, environmental responsibility, inclusion and diversity, ethical standards, and product quality. These responsible business practices contribute to its long-term stability. GSK's financial health is generally good, with a focus on meeting its short-term financial obligations. The company is also investing in research and development, with an expectation that these investments will grow faster than sales, indicating a commitment to future innovation and product development. Number 14, Arbuthnot Banking Group. Despite a slight decrease in profits, Arbuthnot Banking Group increased its half-year dividend by 10% to 22 pence per share, resulting in a dividend yield of around 5.6%. With strong financial reserves and a focus on wealth management, Arbuthnot provides a reliable source of income and a stable foundation. The company has a long history, being a pioneering force in banking since 1833, and operates based on 7 guiding principles. Its financial health is generally considered good, with a focus on maintaining strong capital reserves. The bank's business model emphasizes personalized service and wealth management, which helps it maintain a loyal client base and provides a degree of resilience during economic fluctuations. While the company's stock performance has seen some fluctuations, its underlying fundamentals, particularly its dividend payout and capital strength, remain attractive to investors seeking stable income. Number 13, Wolters Kluwer. In the first half of 2025, Wolters Kluwer achieved revenues of €3.05 billion, a 6% increase, with operating profit rising by 11% to €765 million, and adjusted earnings per share growing by 14%. The company benefits from consistent revenue streams generated by its digital services and the integration of artificial intelligence, making it a robust and highly profitable digital company. Wolters Kluwer is a global leader in providing information, software solutions, and services to professionals in various sectors, including healthcare, tax and accounting, and financial and corporate compliance. Its strong financial health is supported by its recurring revenue model and its ability to adapt to technological advancements. The company's strategic realignments and leadership changes indicate a focus on continued resilience and growth potential. Wolters Kluwer's emphasis on digital solutions and artificial intelligence integration positions it well for future growth in an increasingly digital world. Number 12, Glencore. Glencore's adjusted earnings before interest, taxes, depreciation, and amortization for the first half of the year totaled $5.4 billion, a 14% decrease. Its industrial earnings before interest, taxes, depreciation, and amortization fell by 17%, reflecting challenges in the coal and copper markets. However, the company generated over $2.25 billion in free cash flow and offers a dividend yield of 2.6%. Combined with its cost-cutting initiatives, these factors suggest that Glencore is in a recovery phase, offering an undervalued opportunity in a cyclical industry. Glencore is a major global diversified natural resource company, producing and marketing more than 60 commodities. Its business model is exposed to the fluctuations of commodity prices, which can impact its financial performance. Despite recent headwinds, the company's strong cash flow generation and commitment to cost reduction indicate a focus on financial stability. Glencore's strategic focus on growth in its core metals and energy businesses, along with entry into new markets, suggests a long-term vision for sustained performance. Number 11, Schroders. Schroders reported that its assets under management remained stable at £776 billion in its half-year results. The company is close to achieving £150 million in targeted cost savings, and new business added £4.5 billion. With an attractive dividend yield of 5.43%, Schroders offers income potential despite a high payout ratio, indicating a strategic recovery. Schroders is a global asset management company that provides a wide range of investment solutions across public and private markets. The company emphasizes active management and aims to direct capital towards resilient investments. Its financial health is generally sound, with a focus on delivering strong investment performance to clients. While the company has experienced some fluctuations in profit due to transformation costs, its net operating revenue has shown growth, particularly in wealth management. Schroders is also actively engaged in understanding the connection between financial health and personal well-being, reflecting a broader approach to its business. Number 10, J.P. Morgan Chase & Company. J.P. Morgan Chase & Company is a leading global financial services firm and one of the largest banks in the United States. It operates across various segments, including consumer and community banking, corporate and investment banking, commercial banking, and asset and wealth management. In the second quarter of 2025, J.P. Morgan Chase reported a net income of $15 billion and earnings per share of $5.24. While its revenue saw a slight decrease year-over-year, the bank maintains strong financial performance and stability, highlighted by its robust profitability and solid capital position. J.P. Morgan Chase's business fundamentals are underpinned by its diversified revenue streams, strong risk management practices, and its ability to adapt to changing economic conditions. The company is actively involved in initiatives to promote financial health and inclusion, demonstrating its commitment to broader societal impact. Its strong credit card business and consistent loan growth further contribute to its financial strength, making it a resilient and attractive investment in the financial sector. Number 9, Broadcom. Broadcom is a global technology company that designs, develops, and supplies a broad range of semiconductor and infrastructure software solutions. It plays a crucial role in various high-growth markets, including data centers, broadband communication, enterprise software, and storage. The company is expected to report strong financial results for its third fiscal quarter of 2025, with revenue guidance exceeding $15.8 billion. Broadcom's business fundamentals are robust, driven by its strategic acquisitions, such as VMware, and its strong position in artificial intelligence networking. The company's focus on high-margin businesses and its ability to integrate complex technologies contribute to its consistent profitability and cash flow generation. Broadcom's leadership in providing essential components for artificial intelligence infrastructure positions it for significant long-term growth as the demand for AI technologies continues to accelerate. Its strong financial health and strategic market positioning make it a compelling investment. Number 8, Datadog. Datadog is a leading company in the field of monitoring and analytics for cloud applications. It provides a unified platform that allows businesses to see how their software and infrastructure are performing in real time. In the second quarter of 2025, Datadog reported strong financial results, with revenue increasing by 28% year-over-year to $827 million. The company also generated significant operating cash flow and free cash flow, indicating robust financial health. Datadog's business fundamentals are strong, driven by the increasing adoption of cloud computing and the growing need for comprehensive observability solutions. Its platform helps companies manage complex digital environments, ensuring their applications run smoothly and securely. The company's focus on integrating artificial intelligence and security features into its offerings further strengthens its market position. Datadog's consistent revenue growth and profitability, combined with its leadership in a high-growth market, make it a compelling company with strong fundamental characteristics and significant future potential. Number 7. Taiwan Semiconductor Manufacturing. Taiwan's semiconductor manufacturing company is the world's largest dedicated manufacturer of semiconductors for other companies. It plays a critical role in the global technology supply chain, producing advanced chips for major technology companies, including Apple and Nvidia. In the second quarter of 2025, TSMC reported an 11.3% increase in revenue and a 10.2% increase in net income compared to the previous quarter, with revenues exceeding $30 billion. The company's financial health is excellent, with a strong balance sheet and a low ratio of debt to equity. TSMC's competitive advantage is built on its cutting-edge technology and efficient manufacturing processes. The growing demand for high-performance computing and artificial intelligence is a significant factor driving TSMC's continued growth, solidifying its position as a fundamentally strong and vital company in the technology sector. Number 6. Lennar. Lennar's second quarter results did not meet expectations, with revenue at $8.4 billion and earnings per share at $1.81, falling short of the estimated $1.94. Gross profit margins decreased to 17.8% due to significant incentives offered to buyers. However, the company's management anticipates delivering between 22,000 and 23,000 homes in the next quarter, and affordability-driven incentives may help stabilize demand. This highlights the company's sensitivity to economic cycles but also the underlying demand for housing. Lennar, as one of the largest homebuilders in the United States, is influenced by interest rates, housing affordability, and consumer confidence. Despite missing some earnings estimates, the company's focus on volume growth and cost reduction, along with its strong liquidity, indicates a proactive approach to market challenges. The underlying housing supply tailwinds suggest that there is still strong demand for new homes, which could support Lennar's long-term growth. Number 5. Microsoft. Microsoft concluded its fiscal year 2025 with strong fourth-quarter results, reporting $76.4 billion in revenue, an 18% increase. Its net income reached $27.2 billion, up 24%, and its cloud services revenue grew by 27% to $46.7 billion. With substantial recurring revenue, increasing adoption of artificial intelligence in businesses, and robust financial strength, Microsoft remains one of the most fundamentally resilient companies. Microsoft's business model is diversified, encompassing cloud computing, Azure, productivity software, Office 365, and personal computing, Windows and Surface devices. The company has a strong financial health rating, indicating its ability to meet its financial obligations and invest in future growth. Its strategic focus on artificial intelligence and cloud services positions it as a leader in these rapidly expanding markets. The consistent growth across its segments, particularly in intelligent cloud, demonstrates its ability to innovate and capture market share. Microsoft's strong balance sheet and consistent profitability make it a highly attractive investment. Number 4. Apple. Apple's third quarter of 2025 saw revenue reach $94 billion, a 10% increase, with earnings per share at $1.57, up 12%. Its services revenue hit $27.4 billion, growing by 13%. The company's hardware products continue to perform strongly, and its ecosystem of over 2 billion active devices continues to expand. With growing services and new product opportunities in artificial intelligence and augmented reality, Apple's competitive advantage is both significant and increasing. Apple's business model is characterized by its integrated hardware, software, and services ecosystem, which fosters strong customer loyalty and recurring revenue. While the company has a strong financial position, its debt-to-equity ratio indicates a reliance on debt financing. However, its substantial cash flow and net income demonstrate its ability to generate profits. Apple's continuous innovation in product development and its strategic investments in emerging technologies like artificial intelligence and augmented reality are key drivers for its long-term growth. The company's ability to consistently deliver strong financial results and expand its ecosystem solidifies its position as a leading technology giant. Number 3. Alphabet. Alphabet, the parent company of Google, delivered strong second-quarter results with revenue of $96.4 billion, a 14% increase, and net income of $28.2 billion, up 19%. Its cloud division grew by 32% to $13.6 billion. The company generated a robust $66.7 billion in free cash flow over the last 12 months and holds a cash reserve of approximately $95 billion. With a valuation of about 18 times its earnings, Alphabet is considered an undervalued powerhouse, anchored by its leadership in artificial intelligence and its dominance in the digital market. Alphabet's business model is primarily driven by advertising revenue from its search engine and YouTube, but its cloud computing services are rapidly expanding. The company has maintained high profit margins for decades, demonstrating strong capital efficiency. Its financial health is excellent, with a low debt-to-equity ratio. Alphabet's continuous investment in artificial intelligence and its diverse portfolio of products and services, including Android and Chrome, provide a strong competitive moat. The company is also increasing its capital expenditures to meet the growing demand for its cloud and artificial intelligence services, indicating a strong commitment to future growth and innovation. Number 2. Palo Alto Networks. Palo Alto Networks is a leading cybersecurity company that has demonstrated strong financial performance. In its fiscal fourth quarter of 2025, the company reported a 16% increase in revenue, reaching $2.5 billion, and a 27% rise in adjusted profit. The company's financial health is robust, with a low ratio of debt to equity and high profitability. The chief executive officer of Palo Alto Networks has pointed to a significant shift in the market, suggesting a strong and growing demand for their cybersecurity solutions. As the threat of cyber attacks continues to grow, Palo Alto Networks is in a strong position to capitalize on the increasing need for advanced security measures, making it a compelling company with strong fundamental characteristics. Number 1. NVIDIA. NVIDIA stands out with exceptional performance, reporting $44 billion in revenue for the first quarter of fiscal year 2026, a 69% increase. Its data center revenue alone reached $39.1 billion, up 73%. The company's net income was $18.8 billion, and its operating income was $22 billion. Businesses with high profit margins remain healthy, with non-GAAP margins around 71%. NVIDIA's widespread presence in artificial intelligence infrastructure, its integrated software ecosystem, and its decisive market leadership make it the most compelling investment choice. NVIDIA's business model is centered around its graphics processing units, which are essential for artificial intelligence and high-performance computing. The company's financial health is very strong, with a low debt-to-equity ratio and high profitability. NVIDIA's competitive advantage stems from its continuous innovation in GPU technology and its CUDA ecosystem, which provides a unified architecture for developers. The surging demand for artificial intelligence and its new Blackwell platform are expected to drive significant revenue growth in the coming years. NVIDIA's strategic position at the forefront of artificial intelligence development, combined with its robust financial performance, solidifies its status as a market leader. This carefully selected and ranked portfolio moves from companies that are more speculative or undergoing significant changes, like Tesla and UnitedHealth, to those that are fast-growing leaders in their industries, such as Amphenol, and AppLovin. Each company in this selection was chosen not based on temporary popularity, but on fundamental strengths, including a real growth, demonstrated by increasing revenues, profits, and cash flows. A financial health, indicated by effective cost control, strong profit margins, and manageable debt levels. A competitive advantage, shown through strong market positions, dominant infrastructure, and benefits from regulations or extensive networks. A strategic alignment, positioned to benefit from major long-term trends such as artificial intelligence, digital transformation, advancements in healthcare, and growth in emerging economies. This approach ensures a comprehensive and resilient investment strategy, focusing on companies with solid foundations and promising futures.